Chapter 15, Transfer Pricing. This is going to be one of our shorter chapters. We're not going to work out problems, but instead we will focus on the concept of transfer pricing. Transfer pricing refers to the idea that a business can have different departments or different locations, sometimes in different countries, and those departments or locations can interact with one another, buy and sell to one another. And why would they do that? Well, we're about to find out. First, we'll cover the term transfer price. The transfer price is the value or amount recorded in a firm's accounting records. These are internal records. They're not GAAP financial statements that are presented to the public. Internally, you can keep whatever records you want, as long as they make sense to you. Because the exchange takes place within the organization, the firm can set the transfer price how it wants. Now, why is that? Well, in terms of GAAP, this is an intercompany transaction. You'll learn more about this in your intermediate or advanced accounting classes. An intercompany transaction is ultimately removed before you prepare your GAAP financial statements. It's just an inside transaction with one division doing business with another division. If you can imagine, if we kept all the intercompany transactions in the books, then actually the financial records can be highly manipulated, and so that's why they're eliminated. For example, if a company has low revenue one year, it could manipulate revenue numbers by selling products back and forth to one another. If you imagine, one division could say, hey, our revenue is low, but we have this ballpoint pen. Let's sell it to Division B for $1 million, and that'll increase our revenue numbers, and then you can sell it back to us for $1 million. And now we both have an additional $1 million in revenue per division. But in reality, we know that those wouldn't have been legitimate sales, and so GAAP also recognizes that they're not legitimate, and that's why they have us eliminate all intercompany transactions for GAAP purposes. But for cost accounting purposes, like we mentioned, those are internal records, and since intercompany transactions are internal transactions, they can set the transfer price pretty much how they want. So what should the transfer price be? Remember that this is one company, one big company with two or more different divisions. So in the end, the transfer price doesn't really matter to the overall organization. It's not going to change the company's overall profit. It's not going to change the company profit. And we'll see that in an example coming up. However, these divisions or departments are often measured as if they were separate companies. And so the manager of one division will try to make their revenue and expense numbers look good, and the manager of the other division will want to make their numbers look good. So in a case of transfer pricing, there's going to be a selling division, the division that provides the goods or services, and then the buying division, the division that receives the goods or services. The optimal transfer price that the firm wants to set is a price that leaves both the unit or division managers to make decisions that are in the firm's best interest. Because each manager is evaluated on performance, each manager will want to maximize their own revenues and minimize their own costs. So they work towards their own self-interest. The manager of the selling unit will not sell to the manager of the buying unit if they can sell them for more on the outside market. Likewise, the manager of the buying unit will not buy from the manager of the selling unit if they can buy the item for less on the outside market. So let's look at the example that's in the book. The example in the book is Canyon Dairies. Canyon Dairies has two divisions. They have the milk division, which makes the milk. It manages dairy farms. And that milk can be sold as milk, or it can be used as an input in making cheese. The milk division can sell their milk on the open market, or they can sell it to the cheese division. The cheese division buys milk for the manufacturing of cheese. It can buy the milk from its own milk division, or it can buy it from the open market. And so in reality, it'll most likely be cheaper for the cheese division to get the milk from its own milk division. If it buys milk from an outside source, of course, that outside source will need to try to make a true profit Whereas if it's buying from its own milk division within Canyon Dairies, um, they theoretically should be working for the best interest of the overall firm and not worry about making a profit from its own cheese division. And here we see some cost and production data. This is the cost data for Canyon Dairies. The milk division, in this example, produces 100,000 units of milk, and then it has a manufacturing variable cost of $20 per unit. So the variable cost would be $2 million, which would be the 100,000 times the $20 for $2 million. And then it also has fixed costs of $2 million. So the cost for milk is $2 million variable and $2 million fixed costs, so $4 million in total costs for the milk division. In the cheese division, it tells you that it sells 100,000 units. Their variable cost is $30 per unit, so 30 times 100,000 is $3 million in variable cost, plus the $4 million in fixed cost, so that would be $7 million for the cheese division. So now the firm has to decide whether or not to buy the milk internally or to buy it from the open market. So the primary question is, does the firm's profit increase if the internal transfer takes place? So that should be the number one question for everybody working at that firm with whatever decision that they're making. Will it increase firm profit? If it does, then the firm wants the transfer to take place. Now, the selling division manager, however, might have a different perspective. Given the price transfer, does the selling division's profit increase? So, like I mentioned already, the selling division and the buying division, in many companies, they're treated like separate companies. And so they're going to seek out their own self-interest and try to maximize the profits of their own division. And the same question will be in the buying division manager's mind as well. Does the buying division's profit increase? So for an optimal transfer price, the answer to all of these questions must be yes. So does the transaction increase firm profit? If that answer is yes, well, that's not the end of the story. The selling division manager will want the selling division's profits to increase, or else they might not do the deal. And the same for the buying division. If the selling division's or the buying division's profit doesn't increase given the transfer price, then the managers will not want to engage in that transfer. So it's unfortunate when managers concentrate more on their division's numbers rather than the firm's overall profit. But unfortunately, that's the never-ending struggle in the real world. The main purpose for anyone in the free market really is to maximize their income, right? So if you're an employee, you want to maximize your salary or your compensation. If you're a for-profit company, you're going to want to maximize shareholder profit. If you're a manager, you're going to want to maximize your compensation and the bonuses you receive as well. And so everybody pursues their own self-interest in the free market. But while everyone in a company should theoretically want the same goals and the goals should be aligned, there's always competing goals. And as demonstrated by this example, a division manager may make a decision that might help out their bonus, but might not be the best decision in the interest of the overall company. Now let's look at a demonstration of the concept that we talked about earlier, that the internal transfer price has no effect overall on the firm's profit. So in this example, we have a sales price of $50. At a sales price of $50, that would be $5 million in revenue for milk. And after subtracting $2 million in variable costs and then $2 million in fixed costs, so that's $4 million in costs, they end up with $1 million operating profit. The cheese division has $12 million in revenue. They buy $5 million of product from the milk division. Then they have another $3 million and $4 million in processing costs and fixed costs. So their total costs are $12 million. So you have your 12 million in revenue, and then your 12 million in costs. So the cheese division has a break-even amount at $0, no profit or no loss. So you take the 1 million profit from the milk, the 0 profit from cheese, and the company ends up with $1 million operating profit overall. But let's see what happens if the company uses a transfer price of $60. If they use $60, then milk's revenue is going to be $6 million, the 60 times 100,000 units. The costs are going to be the same, 2 million in variable costs and then 2 million in fixed costs. So you take the 6 million minus the 4 million, and then the milk division has 2 million in operating profits. What about cheese? What about the cheese division? Well, they still have their 12 million in revenue, but now they have an additional 1 million in the transfer costs. So since the milk division has a higher transfer price, instead of a $5 million transfer cost, now it's $6 million. The $3 million and the $4 million costs are the same from the prior example. So if you take 6 plus 9 plus 4, that's 13 million in costs. 12 minus 13 gives you a negative $1 million. So you have a $1 million loss in the cheese division. But you net those two together, the $2 million income from milk and then the $1 million loss from cheese. So ultimately, you end up with the same company profit, the $1 million. So again, this demonstrates that the company can exercise wide discretion in setting the transfer price. It's not going to change the company's total profit overall. Hope that this example makes that concept clear. So we've discussed the scenario in which there was a transfer between two divisions of the same company. Now let's talk about transfers in which there are divisions or locations of the same company, but in other countries. So this type of transfer pricing is what the IRS and the other taxing agencies of the world are more interested in. A company may have economic incentives to set a certain transfer price. What they usually look for is a country with a lower income tax rate, and they either establish a location in that country, or maybe they already do have a location in that country. And then that company might be incentivized to restructure transactions in a manner that would increase operating profits in the low tax country and decrease in the high tax country. So let's take a look at an example of that. Let's look at PDN Pharmaceuticals. I took this example partly from the book, so if you're trying to find an exact comparison, it's not going to be there. So just this example is in the PowerPoint only. We have a company that has a U.S. division and a Puerto Rico division. In this example, the U.S. division has 40 million in revenue, and the Puerto Rico division has 50 million in revenue. So the total company revenue is 90 million. Now, after the third-party costs of 20 and 25 million, the U.S. has taxable income of 20 million, and Puerto Rico has taxable income of 25 million. So overall, the company has total taxable income of 45 million. The tax rate for the U.S. is at 21%, which is the highest corporate tax rate. So that gives you a tax liability of 4.2 million. And then the tax rate in Puerto Rico for this example is 10%. So the tax liability is 2.5 million. So as you can see, even though Puerto Rico has more income, has 25 million versus the U.S. is 20 million, the tax liability of the U.S. is way higher, 4.2 million, compared to Puerto Rico's tax liability. So the total tax liability for the company is 6.7 million. So the company executives look at this and they see that Puerto Rico, they made more money in Puerto Rico but had to pay less tax, whereas in the U.S. they made less money but paid more tax. So they wonder, how can we reduce that amount? Well, one way to reduce it is through transfer pricing, like we've been discussing. If they could reallocate all their sales to the Puerto Rico branch, that would be good since Puerto Rico has a lower tax rate. Now, in reality, this might not be that simple of a solution since there are laws governing transfer pricing and the IRS has a group of economists that focus on transfer pricing. But in theory, let's say there's a perfectly legitimate way to make this transfer. So let's see what that would look like. In this example, the U.S. division would sell 20 million of pharmaceuticals to Puerto Rico, so its entire 20 million of third-party products that it purchased, just transferred it straight to Puerto Rico, and they transferred it at cost. So the U.S. division has no income or no loss. It's at zero. The Puerto Rico division would sell that 25 million of products, as well as the 20 million transferred from the U.S. division for $90 million. And so now total sales is 110 million, right? Well, hold on for a second. You remember you have to remove intercompany transactions. So 20 million of this 110 sales has to be eliminated. So actually total sales is 90 million. Third-party costs are going to be the same, 45 million. And then transferred good costs of 20 million here. That's also an intercompany transaction, so we're going to eliminate that too. So after we subtract the intercompany transfers, we don't have that anymore. So now we're back at the same revenues and expenses as in the first example. First example showed 90 million of revenue. We have 90 million in the second example as well. Taxable income ended up to be 45 million in both examples as well. The only difference now is the tax liability. The total tax in the first example was 6.7 million. And now that we've transferred all of our sales to Puerto Rico, it's 4.5 million. So the company ultimately saved 2.2 million in tax. So now you can see how transfer pricing can happen in the real world with a company that has locations in other countries. So hope this example helps to clarify the concept. And now for the homework, there won't be any problems to work out, but you'll have a few multiple questions to answer. So just to help you solidify these concepts in your brain. And as always, if you have any questions, feel free to reach out via email, or if you'd like to post it on Blackboard under discussions and maybe get your fellow classmates involved in the discussion, that could help as well. Thanks and have a good day.